Okay, let's start. Yes, once again, you are welcome to Strategic Financial Performance Management. And today, as I said, it's very important for your coursework one. Is that okay? At least this session will cover at least 60% of what you need to know or what you need to do in your coursework one. Is that okay? So please, I want you to pay close attention. And today we are looking at the analysis and interpretation of financial statements. How do we analyze and interpret financial statements? Remember when we started, we said the financial statement simply provides financial information about a reporting entity to the various users. Is that okay? Of the financial statement. So we look at the various stakeholders. That is the various group of people who are interested, is that okay, in the financial performance of the company. So you discover that financial statements are prepared to meet the need of various users, various stakeholders. All right? So therefore, the information contained in the financial statement you will discover is more than what you need for any particular decision. And therefore, you need to be able to extract the information you need. You only want what is relevant, is that okay, for your own decision making. You want to make a decision, you should be able to extract the relevant information. Not all the information in the financial statement are relevant to you. And how do we extract this information? And that's what we are going to be looking at today. And that is what your coursework one is all about. Is that okay? Analyzing the performance of a company of your choice. So you will need to choose a company, and as I will say, maybe a multinational company, but it all depends. It's up to you. All right? You can choose a company from your home country. It doesn't matter. Just make sure you have all the information you need. Just look at the financial statement and make sure it contains all the information you need. That is what is important. Is that okay? And when you are looking at financial statement from, is that okay? From other countries, you don't need to convert to any currency. Is that okay? You don't need to convert from one currency to another because the analysis will cover all that. It will take care of that. So whether you do all your calculations in your domestic currency or you do it in pound sterling, it's irrelevant because we are just looking at those indicators. So whatever the currency, it does not matter. Okay? So now, the learning outcomes for this session, by the end of this lecture, you should be able to identify the major categories of ratios that can be used for analyzing financial statements. Is that okay? So, calculate the ratios for assessing the financial performance and position of a business and explain their significance. All right? We said also discuss the use of ratio in helping to predict financial failure of a company. So we want to be able to use ratio to predict the ability of the company to continue to exist in the foreseeable future. And then we will also discuss the limitations of ratios as a tool of financial analysis. Every model has its own words, its own limitations. And ratio is not an exception, because the quality of your ratio, okay, is a function of the quality of the financial statement. Is that okay? From where you obtain your figures. So, therefore, you discover that the quality of the financial statement will have a huge impact on the quality of your ratios. So we will talk about the limitations of ratio calculations, but today we just want to look at how we analyze financial statements. All right? So when we're talking about financial statement analysis now, we will look at different ways of analyzing financial statements. We will look at horizontal analysis, and we will look at vertical analysis. Is that all right? Then we will look at ratio analysis and look at maybe further applications. What are the things we need to consider in applying financial ratios, and the limitations. So, the cautions and limitations of financial ratios. Then, or we can say caution in financial statement analysis. And when we talk of ratio analysis, when we are analyzing a company, we are analyzing a company from 5 main perspectives. Is that okay? We want to look at 5 aspects of a company. One, we want to look at the ability of the company to continue to generate profit. So we want to look at the profitability of a company. Then, what? Efficiency. How well they are using their resources by measuring output against the inputs. So you want to look at the yield, the output, in comparison with what? With the resources put into the organization to generate the output. Is that okay? So we want to look at how well they are utilizing their resources. Then we'll move on to liquidity. When you see some books, they will classify these two together because they are looking at the same thing. All right? The only difference is this is looking at short term, while this is looking at long term. All right? They are both looking at the same thing. If you say liquidity ratios, we are simply looking at the ability of a company to meet its short-term financial obligations. All right? The ability of a company to meet its short-term financial obligations. And solvency is looking at what? The ability of a company to meet its long-term financial obligation. So solvency is measuring the financial risk of a company. Okay? It's looking at the financial risk of a company. And then investment ratio, this is simply looking at what? Return on investment. Simply looking at return to the shareholders. And for you as a potential investor, this will tell you, all right, the return you are likely to generate from that investment. Okay? So now, financial statement analysis, FSA. What is financial statement analysis? If you are saying analysis, what is analysis? Okay? So what is analysis? What do you understand by analysis? Huh?
Using a technique to extract relevant information that is used for making decisions.
Okay, yeah. So when you are saying analysis now, is just talking about what? A systematic review of a data set to generate information. So, yes, when we are talking about analysis now, financial statement analysis, we are simply looking at the quantitative techniques, all right, or the techniques we use in extracting information from a given data set. The financial statements, when we look at them, those figures means nothing. Is that okay? Those figures on their own. If you just pick a financial statement, it will not tell you much about the performance of the company. Let's say you pick the financial statement of a company and the company made a profit of 50 million pounds. Yeah, the profit is 50 million. Yes, the company has made a profit. They've made 50 million. So what does that tell you about the performance of the company? It doesn't tell you anything. Is that okay? You only know they've made a profit, and it won't tell you much about the company. If we now look at another company that has made a profit of, let's say, 100 million, and we are comparing the two companies, you know, ordinarily, when you are comparing the two companies, is that okay? You may be tempted to say, oh yeah, the one that made maybe 100 million profit is doing better. Is that not than the other one? But until we put the profit in perspectives, we can't say which one is performing better than the other. Is that not? What if I now say, okay, the first company that made 50 billion invested a capital of 200 million. Is that okay? The company that made 100 million invested a capital of 1 billion. So which one is performing better? So until we begin to put these figures in perspectives, they mean nothing. So if you look at the financial statement of a company and it's showing a profit of this amount, a profit of that amount, that will not tell you much. So the analysis now is simply using what? A technique, all right? In this case, a quantitative technique to extract all this information from the financial statement. So the figures are just data. Until you analyze them, they mean nothing. It is only then you can generate information. So that is why we are looking at financial statement analysis. We said it's a set of quantitative techniques, all right, used to extract relevant financial information from financial statement for decision-making purpose. And as I said, if you're analyzing the financial performance of a company, why are you doing it? Are you just doing it for the fun of it? You are doing it for a reason. Is that okay? You want to make a decision. If you don't have any business with Unilever, for example, why will you pick the financial statement of Unilever and just be analyzing it? You don't have anything, you are not planning of investing in Unilever, or you are not thinking of becoming their distributor or have any kind of relationship with them. Is that okay? So why then do you start analyzing their financial performance? It's because you want to take a decision. All right? You want to make a decision about the company, and then you need information. But the information you need depends on the kind of decision you want to make. Is that okay? If you are investing in a company, for example, for you as an investor, this is what you will be interested in this. One, is that okay? And you will be interested in this. You want to make sure that if you put your money in that company today, it will not collapse tomorrow. It will not collapse tomorrow. So you are interested in solvency, you are interested in investment. Although for you as an investor, you want to know everything, but these two are very important. And then you will look at the return, whether it's adequate for the level of risk you are exposed to. Then, on the other hand, if you are a supplier, you want to be sure that the company will be able to pay for the goods you supply to them. You want to look at their liquidity. If you will need to supply a company on credit, you will need to look at the liquidity of the company. So, therefore, when you are analyzing for the purpose of doing what? Of making a decision. So, you need to generate the information you need to support your decision making. So, and that's why we said, why do we analyze financial statement? One, we analyze because they contain useful information, all right? And most external users Financial statements are one of the most accessible sources of information about the entity. For you, an outsider, you don't have detailed knowledge of the day-to-day management of the company. So you don't know, all right, much about the internal operations of the company or the performance of the company. Therefore, it is the financial statement that you have access to that will tell you about that company. Okay? That is what will tell you about the company. All right? So, then how do we analyze the financial performance of the company, or how do we analyze the financial statement of the company? One, we have the horizontal analysis, or what we call trend analysis. So, when we are looking at the performance of a company over a period of time, is that okay? You want to see how the company has been performing in an area for the past 5, 10 years. Is that all right? That is horizontal analysis. So you are looking at the trend, and this will enable you to do what? Predict the future. Then we have the vertical analysis, which is more or less referred to as what? As common size. This is where we express a financial statement item as a percentage of another key figure. For example, you want to see the percentage of your sales, for example, that is going into salaries. Is that all right? You want to see the percentage of your revenue that you are spending on what? Marketing expenses. Is that okay? This is vertical analysis. You are expressing your marketing expenses as a percentage of your revenue. So which means when you look at your revenue, you say, all right, for every 100 pounds I make, I will spend 2 pounds on marketing activities, 3 pounds will be on salaries, and so on. Is that okay? That is vertical analysis, expressing a financial statement item as a percentage of a key figure within the financial statement. And you will see that ratio is mostly what? Vertical analysis. Is that okay? So, and when doing your analysis, you are doing what? You will need to do both vertical and horizontal analysis. So for your assessment, you will need both horizontal and vertical. So we say horizontal because you are going to be using 3 years financial statement of your chosen company. So you want to look at the performance of the company over 3 years. And we said that is what? Horizontal analysis. So trend, analyzing financial statement figures over several time period. And we say this is useful when we are trying to track long-term trends. Okay? That may be an indication. If you look at the performance of the company over the years, even when a company is making profit, the percentage increase may be declining. Let's say the profit is increasing year in, year out, but the percentage increase is what? It's declining. That is an indication that what? Your expenses is growing faster or is increasing faster than your revenue. And then you need to do what? You need to do something. That's an indication that something is going wrong, which you need to investigate and take necessary corrective action. So when we want to look at the trend, the performance over time, we do what? Horizontal analysis. And we said in the case of vertical, this is simply when we'll express a financial statement item or figure as a percentage of a key figure. Here, mostly we express income statement items, that is the income, the profit and loss account figures as a percentage of our revenue, as a percentage of the total sales. So you want to see the percentage of your total revenue, okay, that is profit, for example. What is the percentage of your revenue that is profit? What is the percentage of your revenue that you spend on all these expenses? And that is what? A vertical. And for the balance sheet, we mostly express the items as a percentage of what? Of the net assets. Is that okay? Net assets. So, we say this is known as what? As common size. Remember, when comparing companies, in most cases, you will discover they have different sizes. All right? When you are trying to compare companies, just like the example I gave earlier on, one made a profit of 50 million, another one made a profit of 100 million. But that is not enough to enable you conclude that the company that is making 100 million is performing better than the one that is making 50 million. You now need to take what? Their sizes into consideration before you can judge. So when we calculate the ratios, we are simply converting them to the same size. Is that okay? We are not looking at the absolute figure anymore. We are looking at the relative figures. So we are converting them to the same size. 10% gross profit margin is comparable with what? 12% gross profit margin, irrespective of the size of the company. So we have converted them to what? To a common size, to the same size, when we calculate the ratios. And then we can make comparison between two companies to know which one is performing better. If you take the raw figures, all right, on the financial statement, that will not tell you much. So that cannot help you to make comparison between two big companies. All right? Is everybody okay with that so far? You're not confused yet? Okay. So let's start gradually. And now I want you to follow gradually. Is that okay? Let's take it step by step. The first one is our horizontal analysis. Now, if we look at horizontal analysis, we are simply calculating the percentage increase from one period to another, as we said. So here, we are looking at the percentage increase from the prior year. Let's start with turnover. We want to look at the percentage increase in turnover. Is the company's revenue growing? Is that okay? Is revenue growing? What is the percentage growth in revenue? The company made a turnover of 4.35 million in 2004, all right? But that increased to 6.59 in 2005. And we are saying, what is the percentage increase? The percentage increase, remember, you are moving from 2004 to 2005. So 2004 is your base year. Is that all right? The prior year is your base year. So what you need to do is to find the difference between the two. That is 6.59 minus 4.35. And then you divide by your base year, which is 4.35, multiplied by 100 over 1. And that will give you 51%. We said you need to find the difference between the two figures. All right? And then you divide it by your base year. So here, because we are moving from 2004, we are looking at the percentage increase from 2004 to 2005. 2004 then becomes your base year. Is that okay? So find the difference between the two figures. That is 6.59 minus 4.35. That difference, then you divide by your base year. That is 4.35. Multiply by 100. And that will give you 51%, what we have here. So which means the company's revenue increased by 51%. Revenue has increased by 51%. Is everybody clear with that? Now, if you look at your cost of sales, your cost of sales increased from 2.82 million to 4.22 million. What is the percentage increase? This is simply 4.22, all right, minus 2.82. That difference divided by 2.82 multiplied by 100. And that will give you what? 50%. So it has increased by 50%. Have you checked?
Yes.
Has anyone done the calculation? Okay? You are okay? Another person? Everybody's okay? So far? All right. So now it means it has increased. But if you come here and look at your interest payable, you will discover it actually declined. You paid interest of 70,000 in 2004, but that decreased to 60,000, which means probably the company has been able to pay off some of its debt. So interest on loan has what? Has reduced. All right? If you now look at this percentage increase, you can see that, well, your selling and distribution expenses increased by 88%. It increased by 88%. But your turnover only increased by 51%. Now, if you look at it, this absolute increase, this increase should not really bother us too much. Is that okay? But we need to understand why. Because that may be an indication that something is going wrong somewhere. It is when we begin to investigate. All right? We said the magnitude, we don't read too much into the magnitude of the changes. Is that okay? But we need to understand why. And this is why I can say a number of people get it wrong in the assessment. So you need to note now that when you do your calculation, although we will talk more about that when we get to ratio analysis, you are being asked to analyze or to evaluate and not describe. What a lot of people do is simply to describe. Just, oh yes, revenue increased by 52% from 2004 to 2005. It increased again by 54% from 2005 to 2006. Yes, we can see that from your calculation. You are not providing any new information. Is that okay? So if you begin to say that, that's just description. You're only describing what you have calculated, and you have not analyzed the performance of the company. Is that okay? So when you look at your assessment, your calculation of the ratios alone will only earn you 15%. That's 15 marks. All right? The evaluation will earn 35 marks. So it is the evaluation now, the analysis, that what? That you need to focus on. Where you have what? An increase, you need to explain, you need to tell us why it has increased by 88%. Why has it increased by 88%? Then look at the trend, maybe for the past 3 years, because you are using 3 years financial statements. You look at the 3 years trend, you just have a jump in one of the years. Why that? All right? Discuss the trend, and then you benchmark that performance. Is that okay? That's how you analyze. That's how you evaluate. Okay, if we have a big jump, that may not be an issue. It may be an industry problem during that period. So it's not peculiar to your company. Therefore, we should not fret over it. Is that not? But if it is peculiar to your company, that is when you now begin to think of how to solve that problem. Is that okay? So we are saying until you benchmark, you cannot say much about the performance of your company. And this is where the evaluation comes in. So if you are just saying the profits increased from 20% to 25%, that means nothing. So the maximum that can earn you out of that 35 is just 10%. All right? 5 to 10, that's all. Over 35. And this is where a lot of people get it wrong. So I'm taking time to explain now so that you will note it. When you start preparing your assessment, you know what you need to do. Okay? Don't just come and describe your calculation. You need to do what? To evaluate the performance of the company. Its performance we're evaluating. All right? So if you look at all of them, you can see the percentage increase, and we'll say this is horizontal analysis. Is everybody okay with that? All right. So vertical. Remember we said in the case of vertical, we are simply expressing the financial statement items as a percentage of another key figure. Here, that your key figure is 100%. Is that okay? Your reference figure is always 100%. In the income statement, we normally express all income statement items as a percentage of your revenue. Okay? As a percentage of your sales. If we look at the vertical analysis, let's look at it. Your turnover, which is your reference figure now, is 100%. So, your cost of sale, all right? What percentage of your revenue goes into the cost of sales? And we say that is what? 4.22 divided by 6.59 multiplied by 100 over 1. Is that okay? And that will give you 64%. Have you tried it? Just try. Do your calculation. Let's see. Are you okay with that? Do you agree? Yes. So your cost is what? Is 64%. That is, your cost of sales is 64% of your revenue. So you know that what? For every £100 sale you make, 64% represent the cost of the item, either the cost of production or the cost of buying the items. Remember I said, when preparing financial statement, okay, let's assume this is the product you are selling. This product costs you £6. You buy it for £6. And you are able to sell it for £10. The first thing we want to see is your ability to sell your product at a price greater than your cost. And that is why you have the turnover, the revenue, or the £10 income minus your cost of sale, the cost of the item. So we want to see your margin first. It is from this margin that you will then meet the other expenses. And the cost of selling the item, maybe you have your warehouse or you have your office rent, your warehouse rent, you pay staff salaries, you pay marketing expenses, advertisements, and so on. These are your operating expenses. So it is from this margin now that you will then deduct the operating expenses. So you have what? Your gross profit margin. So if you look at it there, that is what is showing. We have our revenue or turnover minus cost of sales, and that will give us gross profit. Okay? So what percentage of your sales or your revenue is what? Is gross profit. This simply means on every £100 sale, you are making a profit or a gross profit of what? 36%. That's £36. It is 36%, which means you are making £36. And that will then enable you manage the other expenses so that you make sure, because the cost of the item is the most important thing. Yes? That's your most important cost. Then the other cost, you will then make sure you manage them in such a way that they are not up to £36. If you want to make a profit, the other expenses must not be up to that £36. So that is why we want to see your gross profit first, and then we look at the other expenses. The administrative expenses, 380, 300 in the prior year, When you calculate it, it's only what? We only have 27% increase in admin expenses. While turnover increased by 51%, the cost of sales increased by what? 50%. Because your cost of sales is directly related to your sales. So it is a variable cost. It varies proportionately with your revenue. Is that not? It varies proportionately with your revenue. Therefore, if you have a 51% increase in turnover, a 50% increase in cost of sales is not out of place. We expect them to be close. Is that all right? But your admin expenses is expected to be relatively fixed. Only a small proportion of that will be variable, because if you are operating from this room, all right, depending on the capacity of the room, whether you make turnover of 20 million or you make turnover of 30 million from this room, your rent will not change. Is that not? If you make 20 million this year, and next year you now make 30 million, will your maybe landlord now come and say, yeah, because you have made 30 million this year, your rent has increased from 12,000 to 15,000. No. You have an agreement, maybe for a year, this is the amount you are paying. Whether you make 20 million sales or 30 million sales, that will not change. So we expect certain elements of the cost to be fixed, while some may be slightly variable. So admin is classified as what? As fixed overhead. But we know that this has increased by 27 because probably we need to maybe increase the number of staff and so on because of the growth in revenue. We can see turnover increased by 51%. You may need to hire more maybe salespersons and so on. Is that okay? Marketing staff. So that cost can increase, so which is fine. 27% is okay. It's not too bad. So you can look at all the others. We have the selling and distribution. Okay? All you just need to know is why they have increased. And that is your vertical. So you are calculating each item as a percentage of your turnover. So you are saying, in terms of your turnover, now, this one is, what? This one is 5%. So for every 10 pounds turnover, you are spending 5 pounds on what? On selling and distribution. Is that okay? That's what it means. Is everybody okay with that? No, sir. So what is no? You don't understand what? Huh? Why are they increasing? Because the company is growing. Is that not? Yes, I think I explained the partners. Probably because the company is making more money, they have to pay off their debt. That's interest now. It's the interest on loan that decreased. So they've paid off part of their debt, so they are not paying as much interest again. Is that all right? So now, what is your problem? To see if we can help you. Eh? Still leave assessment alone. Your assessment, we talk about assessment. I'm just highlighting some things you need to take note. Leave assessment, we'll still talk about the brief. Mm-hmm. Yeah.
You said as business manager,
yes.
you really need to concentrate on stuff like this.
On which stuff? Stuff like what? Yes, and I said interpretation. Your focus, you are not required to prepare the financial statement, but you are required to analyze. So it's the analysis and not the preparation. The preparation of a financial statement is different from the analysis. So the preparation is the work of the accountant and not your work. You just need to understand how we arrive at some of these figures. That was why we had to do double entry, do all that. So here, we say when we are analyzing the financial statement, we are simply trying to extract information, to generate information from the data. The financial statement will simply present you a set of data, Is that right? So you now need to be able to generate the information you need from there. So, and we said you can do horizontal analysis and you can do vertical analysis. All right? And you can do ratio analysis. Yes.
I'm just confused. I understand 100%, 60%,
64.
36, 46, 5, and 5.
Which one? 6. 380 divided by your turnover. That will give you 6%. 320 divided by 65.90 will give you 5%. 1670 divided by 6590 will give you 25%.
Everything will be multiplied, divided by
Turnover. That is the key figure. Multiply by 100. Is everybody okay now? See the person shouting now. You are not listening to me. No, you are not. Huh? You are busy with another lecture. Okay, so that is vertical. I hope everybody's okay here now. All right, this is just to tell us. If you look at ratio analysis is more or less a vertical analysis. We are expressing one financial statement item as a percentage of another one. Is that okay? So when we get to ratio analysis now, ratio analysis, here we say it is just what? It's a numerical technique. This one is a quantitative model or a quantitative technique we simply use to summarize and interpret financial statements. Instead of just looking at the figures, this is the profit for the year, or this is the revenue, this is the cost of sales, this is the profit, and so on. Just calculate your ratio. The ratio will just give you the summary. Is that okay? And it will present maybe a better information than just the financial statement itself. Because those figures will not tell you much until you put them in what? In perspectives. And then that will then begin, the financial statement will begin to make sense. It will present the information you need from the financial statement to you. And then that will enable you to make the decision you want to make. All right? So, what is the motivation, or what are the motivations for using financial ratios? We said to act as summary statistics to replace the complexity of what? Detailed financial statement. So here, your ratio will just be a summary. The expectation is that in your assessment, you will have a summary table. Okay? You will have a summary table for all your ratios in your main report. And all your workings will be in the appendix. Okay? You will put all your workings, all the calculations, because I want to see where your figures comes from. I want to see your formula. All right? I want to see all the formulas, everything. They will be in the appendix. And then, in the main report, you will then present a summary of your ratios. You have a table to show the summary of your ratios. Is that okay? So, when we start discussing the brief, we will talk more about that. Is that okay? So now, to act as what? Industry benchmarks for performance comparisons. And this is another area. When talking about evaluation, the expectation is that, look, if you are analyzing the performance of a company, I will also expect you, it's normal. I think I made this very clear right from day one, from the first lecture, that you only discuss performance in what? In reference to a benchmark. If you don't have a benchmark, you can't talk about performance. You can't say whether a company is doing well or not if you don't have something to measure it with. Is that okay? You need to compare your actual or the figure for your company with what? With a benchmark. Either another company, a competitor, or industry average. So the expectation is that what? You will benchmark the performance of your company with another company, a close competitor, or if you have access to the industry average, tell us how well your company has performed in comparison with what? With a benchmark. So I will also expect you to calculate the same set of ratio for a competitor. Is that okay? You will calculate the same set of ratio for a competitor so that when you are evaluating the performance of your company, then you can discuss it in comparison with that company. You will benchmark the performance of your company with another company. Is that okay? That is evaluation. You are moving away from description. So if you are just telling me it increased by 5%, it makes no sense to me. It doesn't tell me anything. I can see that from your calculation. So you have not said anything new. But when you now begin to say, yes, while the company made a profit of 10%, all right, a close competitor was only able to make 8%. Yes, that is to show that what? Your company is not doing badly. Or if you know the industry average is 7%, but your company made 10%, which is above the industry average. Yes, which means your company is performing well. Is that not? So, this is the way you evaluate performance and not just describe what you have calculated. Is that okay? So, I hope everybody is very clear with that now. And so, all these ratios we calculate, we can then use them as benchmark. These are the things we use to calculate the industry average at the end of the day. When you look at an industry, you calculate the relevant ratio for all the companies in that industry. Then you find the average. That becomes what? The industry average, which you can then use to measure the performance of all the companies within that industry. Is that okay? So, also, say it's an input into a formal decision models. We'll talk about some models. You discover that when you are analyzing the financial performance of a company, you are trying to test some hypotheses. It's not the profit you will put there. Is that okay? It's not the profit. If, for example, we are trying to look at maybe the possibility of failure, the model we use in predicting, is that okay? Business failure. We don't use the raw data, that is the financial statement data. It is the ratio you calculate that you will put in the model for your final calculation. Is that okay? Even when you are testing hypothesis, you have your models. If, for example, you are trying to measure maybe the performance of a company, you want to see the relationship. For example, you want to see the relationship between the performance of a company and the number of female directors. So how do you do that? Is it the profit you are going to put there? No, it's the ratios you will put in your model. Is that okay? So you look at your company performance, then you define your variables. So it is the ratios calculated that you will use in the model and not the profit figures. Is that okay? So we said it's also a standard for what? Now quickly, let's look at ratio analysis. And this is where we are going now. Today, is that okay? All this horizontal, the vertical is just to show you how to analyze the performance. But this is what you will use to analyze the performance of your chosen company, the ratios. So when you calculate the ratios, you will look at the performance over the years, explain any significant what? Change, and look at it across maybe the sector by benchmarking the performance. And at the end of the day, you'll be able to explain the performance of the company. So when analyzing the performance, remember we said we have 5 main areas, 5 categories of ratios. We have profitability, which is a performance ratio. Is that okay? We have efficiency ratios. We said we have the short term, which is liquidity ratio, and long term, we have solvency. We use solvency to measure the long term ability of a company to meet its financial obligation. And then finally, we have the investment ratio, which we said investors are interested in. All right? So here we're going to use 2 main companies, AZ and GSK. And that is why in your assessment you will see in the brief, you are not allowed to use any of these 2 companies in your assessment. The moment you put AZ there, that is 0. Or you put GSK, that is 0 score. So, if you are passionate Yeah, okay, so you divert your passion to somewhere else. Okay? So you need to divert your passion to somewhere else and write on a different company. Nobody should go near AstraZeneca or GSK. Is that okay? Because that is what we are using in the class. So you can't touch them. All right?
I was thinking.
Thinking, all right.
Yeah, I feel we should have used a service company.
You should have used a service company.
Yeah, instead of product, to make it better for us, because most of us might choose, let's say for example, GSK, they produce goods and services, and let's say they produce paracetamol, they produce.
Yes, they are products.
They have products they are selling,
Yes,
and I'm using HSBC bank.
yes,
They don't sell products.
Yes.
They sell account numbers.
yes. So one. Okay, one. You have not sampled everybody's opinion. Is that okay? So don't say it's better for you, for all of you. It's better for you as a person. You may want to write on a service company. Is that okay? Now, that's why we are converting it to common science. Whether you are writing for a manufacturing company or you are writing for a service company, interpretation is the same. Is that okay? So the only thing is the terminologies. All right? And this even differ from industry to industry. Now I agree with you. And I must warn you, if you are writing on the financial sector, make sure, is that okay? You are conversant with the financial sector. Is that okay? Because you will discover the presentation of their financial statement will be maybe slightly different. Is that okay? And the interpretation, you need to be careful again. Is that okay? So make sure if you are writing on it, either you are a banker, you understand it very well. Is that okay? If not, I will say it's better to look for the easy way out. But if you decide to go down that line, well, you're on your own. That's your own decision. That's just what I would say. You can go for it if you love the financial sector. Go for it. If you are passionate about it, yeah. If you are passionate about financial sector, go for it. Is that okay? So now quickly, because of our time, we say we're going to be using AZ and GSK for illustrating the financial performance. Let's look at the two companies. Now, what I've done is, this slide, all right, has the original slide. In the folder, you will find the financial statement for 2020-2021 for both companies. And when you get home tonight, after eating and sleeping, when you wake up, I want you to repeat the same thing. Is that okay? So, whatever we are going to cover now, and I want you to do it for 2020-2021. The same companies, yes. Look into the folder, you will find the financial statement there. All right? So they are there for 2020-2021. So I now want you to look at their performance again. Then we can then look at the performance over the years. Is that okay? So now, if you look at the financial statements, remember, we start with our income statement. We have your turnover, your cost of sales, then the gross profit, your turnover less cost of sales. We have for AstraZeneca for 2006, 2005, and for GSK for 2005, 2006, we have the figures. So you have your gross profit, selling, general and administrative cost. Then you have research and development. You have other operating income and expense, 307, 346. You have share of after-tax profits of associates. Remember last week we talked about associates. Can you still remember that where you have an associate, you are allowed to report your percentage holding. You will need to calculate your own percentage of the company's profit and recognize it in your own account. Is that okay? So, because that's your own portion. And that is why we are seeing it here. Then we have operating profit, finance income, all right, interest income, interest on short-term deposits. So this is an income. Then we have the finance expense, all right, which is interest on loan. the interest they paid on loan, and then we have profit before tax, 7799 for GSK and 4365, and we have our taxation, then we have profit after tax for GSK and for AZ. Then we have the profit attributable to equity shareholders. In this case, we are referring to the equity shareholders of the parent. Remember that a company, a group, may also have subsidiary. Is that okay? And I said, where a company holds up to maybe anything above 50%, and the example we gave last week was maybe 75%. They own 75% shares of a company, of another company. Then that company automatically becomes their subsidiary. So when they are preparing their annual report, they would then need to consolidate the financial statement of that subsidiary line by line. They will add their revenue, and that is why when you pick the financial statement of your company, please note, you will see the group. Is that okay? You will see one, they say company, and you will see the other one, they say group. So the company is the addition of maybe the revenue for the parent and the revenue for the subsidiary, and that will give you the group revenue. Is that all right? So just be careful. Whichever company you decide to choose, look at their financial statement. In that case, you are going for the group. Is that okay? Go for the group report. That's what you need. Now, they own 75%, which means 25% belongs to other investors, who are the ones we refer to as what? As the minority shareholders. That is minority interest, or some companies will call it non-controlling interest. Is that okay? If you see non-controlling interest or minority interest, we are talking of the same thing. So we simply refer to the remaining 25%, which belongs to other investors. Is everybody okay with that? So now, this is what we now have here. Profit attributable to minority interest. So they have a subsidiary. That's the portion of the profit of that subsidiary that belongs to other investors, because they don't own 100% of the shares of the company. Is everybody okay with that? So now, that's the income statement. Then we have the balance sheet. So our balance sheet, we went through all this last week. You can see the assets. You have the non-current assets, property, plant, equipment, intangible assets, and so on. Then we have the current assets, inventories, trade receivables, other receivables, prepaid expenses. And then we have what? The total assets. This is the total non-current asset. This is the total current asset. The addition of these two will give you the total asset. Is that okay? That gives you the total asset. Then we have the liabilities. So your liabilities, we have the current liabilities, and we have non-current liabilities, and that will then give us what? Total liabilities. And when you deduct the total liabilities from the total assets, your total asset here, minus the total liability, that will give you what? The net assets. Okay? This is simply showing you how much the company is worth today. When you as an investor, you want to buy the company, this is what you are looking for. This is what you want to pay for. Is that okay? Because if you buy the company, you are taking over all the assets, but at the same time, you are taking over all the liabilities. You are the one who will pay off those debts. So you want to make sure you deduct the debt from the asset to determine how much you pay. So if you just pay for the total of the company's assets, you discover that what? You are paying too much, because you will still pay those debts. Is that all right? So when you add the debt to how much you have paid, then you have overpaid for that company, you have overvalued. And that is why you are interested in what? In the net asset. That is the net worth. That's how much the company is worth. So for you now, let's say you have £5,000 in your account, and you are owing people £2,000. If you want to calculate your net worth, you are only worth how much? 2,000. because you need to settle 2,000. So what is left that is your own that you can spend is only 3,000, and that is your net worth. Eh? Okay. That is if you get someone to, if they know you are carrying too much debt. Eh? All right. You have a question?
Yeah, so when an acquisition happens,
Yes.
when they put out the number that they acquired a company, have they done that calculation of due diligence?
Yeah.
Say the number they put out,
Yes.
is it the net asset that they pay?
Okay. I think last week we talked about goodwill and so on. That final figure, so many things will go into it. It's not just the net asset. So I'm just saying this will form the basis for negotiation. Is that okay? This is to show you how much the company is worth now. We may then have what? Acquisition premium. How much would that premium be? That would then that would now depend on the reputation of the company and some other things. So we have so many things going into that. We'll talk about that when we get to company valuation. Is that okay? We will still do company valuation and then we will talk about. Is that okay? All right? So quickly now, before we move on. Yes?
Yes, sir. You mentioned that we should take into consideration the financials of a company that is a group. That if the company is a group of companies, that we should take into consideration the new financials of the group as a whole.
No, I said yes. What you are looking at is what? Is the group report.
Yeah, so I wanted to ask if that's going to give a fair reflection against the industry where other companies are not a group of companies.
Okay. So now, we are now down to size. Is that not? That will reflect on the size. So, there is nothing fair or not fair about this thing. Is that okay? It depends on your financial strength. If you have, and that's why you find a lot of companies acquiring other companies within the industry to become bigger. All right? They want to control the industry. So that gives you more what? Market share and gives you more control over the industry.
Yeah,
That's competition.
the scenario that actually popped in my head was like, for example, MTN,
Okay.
because they are not just operating in the telecommunication industry,
Okay.
they have the financial services as well.
Yeah.
So if you are comparing such a company to the likes of maybe Globacom or Airtel, which only operate as a telecommunication company, so the benchmarking and the analysis be fair.
You have calculated the ratios. The ratios, what? Have converted them to the same size.
Oh, okay.
So it doesn't matter anymore whether this one is 100 billion company, 100 billion pounds company, and that one is only 200 million size company. Your ratios have converted them to the same level. So that's the essence of the ratio. That's why we use ratio instead of what? The financial statement figures. You don't compare their profit. Is that okay? When you are making comparison, you can't compare their profit because they are not of the same size. And therefore, when you calculate the percentage, maybe you are calculating the gross profit margin, you are converting them to the same thing. You are simply looking at the ability of each company to do what? To generate profit from its sales. So it doesn't matter whether the company is 200 billion, this one is 1 billion. Is that okay? They have become the same. You have converted them to the same level. Is that okay? So that's the essence of using ratio. That's the benefit of ratio. You will neutralize that size. And that is why we call it common size. That's the vertical analysis. So that's why we call it the common size analysis. Is that okay? So now, you have the balance sheet, then you have the net asset, and you have your equity. Look at it. Your equity is the same as the shareholders' fund. Bear that in mind. Is that okay? The shareholders' fund is the same as what? As your equity. So your shareholders' fund, which is this, your equity. This is the portion that belongs to the other shareholders of the subsidiary. Is that okay? But this one is the portion that belongs to the shareholders of the parent. and that's your shareholders' fund. So this is the minority interest. All right? So please note. I will expect you to open this financial statement now, either on your phone or on your laptop, so that when we start the calculation, you will know where the figures are coming from. I can't be going up and down, going through the slides every now and then. Is that okay? So if you have it open, you will be able to see the figures. All right? So let's start with the profitability ratios. Our time now. Okay? What is profitability ratio? And therefore, when writing your assessment, I will expect you to start by defining your ratio. Is that okay? What does it mean? What does it measure? So you will start with the explanation of your ratio. What's your ratio all about? Is that okay? So here, we are talking of profitability ratio. Why do we calculate the profitability ratio? What's the purpose? To assess the relative success or failure of business performance. And we are saying, especially in terms of profitability, you want to look at the profitability of a company. That is the ability of a company to convert sales to what? To profit. Whether they are able to sell their product at a price higher than their cost. Is that okay? So, and here we are saying the most commonly used profitability ratios include what? The gross profit margin, the net profit margin, return on equity, and ROCE, return on capital employed. Is that okay? So, in the industry, we can say they are all popular, and they are simply what? Yield measures. They are simply looking at your output against your input. That is looking at what you have been able to generate from the input into the organization. Is that okay? So you are looking at the output from the resources committed into the company. So it's a yield measure. Profitability is a yield measure, and you need to understand we calculate profitability in percentage figures. So please note again, because this is where people lose marks. When you calculate your ratio in fraction, is that okay? You now say the profitability ratio is 0.2. What is 0.2? 20%, is that not? And you are saying 0.2. You will only get marks for the process. The final answer, you will not get the marks for it. That's it. Because it should be 20% and not 0.2. So profitability ratios are measured in percentage figures. So I want you to take notes now so that you don't make that mistake when you start writing your assessment. So now, gross profit margin. As I said earlier, we want to measure your ability to sell your product at a price greater than the cost of that product before we now take into consideration other operating expenses. And that is why your gross profit margin is very important. So we look at the gross profit margin, okay, which measures profitability in buying or producing and selling goods before taking any other expenses into account. It simply shows the proportion or the percentage of sales which resulted in a gross profit. So how do we calculate it? This one is very straightforward, and yeah, a lot of people get this right. It's just what? Your gross profit over sales multiplied by 100. And that will give you what? Your gross profit margin. That's all. Okay? So the next one, your net profit. Measures net profit made as a percentage of sales. You want to look at the percentage of your sales that what? That result in your overall profit, your net profit. That is, now here we have two main formulas for calculating this. Whichever one you decide to use is fine, but we prefer what? The first one. Okay? If you use any of them, you are right, and that is why I said you need to show your workings and clearly show your formula. So you have marks for the formula. It's not just the final answer we're interested in. You have marks for the formula, for your figures, the calculation, and the final answer. All right? So now, your net profit can be calculated, net profit margin can be calculated as what? Profit before interest and tax divided by sales. Okay? So that is profit before interest and tax divided by sales, multiplied by 100. Okay? That's your operating profit margin. Or you can calculate it as what? As profit after tax divided by sales, multiplied by 100. Whichever one you use is acceptable, but we prefer the first one because what? When you are measuring the performance of someone or of an organization, you measure the performance based on factors within their control. Is that okay? When you are looking at the performance of someone, you want to measure the performance of the person based on the factors within the person's control, not outside the person's control. For example, if we decide to go for the second one, if you take profit after tax, the company has no control over tax. Is that okay? So they cannot decide this year we want to pay tax, next year we are not paying tax. It's the government that determines what? And not the company. So when you are measuring the performance of the company based on what? After tax profits, then you are including factors which they have no control over. All right? So that's why we prefer the first formula. All right? Then we have return on equity. So here, you are looking at profit after tax, minority interest, and preference dividend. Now, here, we know that some companies still have preference shares. Okay? If your company has preference shares, remember their own dividend must be paid before ordinary shareholders are paid. And preference dividend needs to be what? To be separated from the profits of the company. It is what is left that belongs to the shareholders after paying preference shareholders. They take priorities over ordinary shares holders. So therefore, we need to deduct that. It's whatever is left that now belongs to ordinary shareholders. So we look at our profit after tax. Okay? We deduct minority interest and then deduct preference dividend. Whatever is left now is what belongs to the ordinary shareholders. So therefore, when we are trying to calculate their percentage return, it is this profit after tax, minority interest, and preference dividend divided by what? The shareholders' fund. That is equity. Remember, I said the shareholders' fund is the same as equity, which represents the portion of a company's capital that is contributed by the shareholders. Hope everybody's okay with that? So that represents the portion of a company's capital that is contributed by the shareholders. The other thing here we need to notice, all right, if you use the closing figure, it's fine, but in most cases we prefer the average shareholders fund. Is that okay? We prefer that you use the opening shareholders fund plus the closing shareholders fund divided by 2. And that will give you the average for the year. Because, remember when you started trading that year, you started with the opening shareholders fund. You generated that profit or the revenue over the year. Is that okay? During that financial year. And therefore, that closing figure is not what you started with. You built that amount right from the beginning. And that's why we prefer the average of the two. But if you use closing, nobody will penalize you. Is that okay? If you just go for the closing shareholders fund, that is fine. All right? So now, the last one is rows. In the case of rows, we are calculating the what? The return on capital employed. You are simply looking at your profit as a percentage of what? Of capital used in generating that profit. return on capital employed, and this is calculated as profit before interest and tax over capital employed. How do we calculate capital employed? The correct way of calculating capital employed is shareholders' funds plus preference share capital plus minority interest plus interest-bearing debt. Is that okay? Because we have some debt that are what? That are not interest-bearing. Example, creditors. If you are owing your suppliers, do you pay interest on what you are owing them? No. Deferred tax could be a long-term debt. Are you paying interest on deferred tax? No. Is that okay? So, your capital employed includes all forms of what? Capital resources. Equity capital, preference share capital, and interest-bearing debt. And we say what? The return measure, therefore, includes all profit made before any appropriation. And that is why we take profit before interest and tax, before you pay the debt holders, because we are also including the debt value in the calculation. So it has to be the profit made by the company before paying any capital provider. Is that all right? So your profit before interest and tax will be the same as your operating profit if you have no other income. Is that okay? If there is no other income, then your PBIT is the same as what? As your operating profit. So here, that is how we calculate ROS. Yes. Were you listening? I said, ordinarily, yes, average is preferred, but you can use the closing shareholders' funds. Nobody will penalize you. Because if you decide to use the average, you need to be consistent. This is where a lot of people, again, go wrong. Because at times, when you get your results, you begin to wonder, why did I not perform so well as expected? These are some of the little things. You find someone, for example, in the first year, let's say you are looking at 3 years. You are looking at 2020, 2021, 2022. Now, in 2020, you don't have the opening figure. You only have the closing figure. So you decide to use the closing shareholders fund. Now, in 2021, you have the 2020 figure and 2021. So you have the opening figure, and you now decide to go for what? For average. That's inconsistency. I think from week 1, I explained it, that in accounting, we believe so much in consistency. If you are applying any particular principle, you need to apply it, or any policy, you need to apply it consistently. So if you calculate the first year using closing shareholders fund, and you are now using average, that's inconsistent. Is that okay? You are now using average for the remaining 2 years. That's inconsistent. And this is where you lose all those 1-1 half marks. Is that okay? So that consistency. If you want to use closing, use closing. If you want to use average, then go back and get the 2019 financial statement and make sure the first year you also use average. Is that all right? So in that case, you want to use average all through. If you are using average, use average all through. If you are using closing figure, use closing figure all through. Is that consistency we want? Is that all right? So now, our time. Now, we are looking at capital. We said capital improves debt, preference shares, that is borrowing now, ordinary share, all right? Minority interest, you have ordinary share, parents. And then you have your P parts now, profit after tax, you have your profit before interest and tax, PBIT, and so on, which we use in calculating our ratios. That is compensation to the various what? Capital provider. So when we are looking at capital employed, remember I said this is the right formula for capital employed. But yeah, if you decide to go for the easy way out, you will not be penalized. Is that okay? Which is just taking your total assets. Is that okay? If you just say total assets minus current liabilities, nobody will penalize you. Is that okay? That's the easy way out. Is that not? Instead of thinking, oh, which one is interest bearing, which one is not interest bearing. So just take your total asset minus current liabilities. That's your correct capital employed. It's also acceptable. But this is the correct calculation. If you calculate it that way, it's acceptable. So you will find some books, that's how they will calculate their capital employed. That's total assets less current liabilities. If you decide to use that, nobody will penalize you. And that is why I said, just show your formula. All right? Show your formula. That's the gentleman's way. All right? The easy way out. Don't complicate your life. All right? No complications. Okay, so now, quickly, let's now look at the two companies. GSK, we want to look at the performance of these two companies. We want to calculate the gross profit margin for AZ, AstraZeneca, and GSK. Looking at our gross profit margin, if, remember we said our gross profit margin is simply equals to gross profit over sales multiplied by 100. So can you check the financial statement and extract these figures? Your gross profit. All right. So let's look at AZ 10,687, 13,527, and for GSK 18,215, 23,225. If we go back to the financial statement, so you can see the gross profit for AZ. This is the gross profit, and the gross profit for GSK. And what of revenue? Our sales, which I said is the same as your turnover, your revenue, your income, or you say your total sales. They are all the same. So if you now look at it, we have 13,527 and 23,225. Okay? So note those figures, and when we come to the formula here, so you can see them here. For AZ 10,687, that's the gross profit, and this is the what? The turnover. Gross profit divided by the turnover multiplied by 100, that gives you 79% for 2006. But for GSK in 2006, okay, for GSK in 2006, we have 18,215. So can you look at your financial statement and see where the 18,215 is coming from? I believe everybody can see it. Divided by 23,225, then multiply by 100. Okay? So multiply by 100. Multiply by 100. And that will give us 78.4%. Okay? For 2005, we have 77.6, 78%. And in terms of the net profit, look for your profit before interest and tax. Look at the income statement. Can you see the profit before interest and tax? Remember I said if there is no other income, it will be the same as your operating profit. All right? So look at these figures now. Your operating profit, which is 4218, 7864. So you can see, all right, 4218. Okay, that's your operating profit now. 4218 and 7864 for GSK. All you need to do is what? Then divide it by your revenue again. All right, your sales. Multiply by 100, and that will give you 31.2, 27.2. So if we now compare the two, do the calculation. So which one is performing better? Yeah, in terms of gross profit for 2006, AZ is better because they recorded what gross profit margin of 79%, while GSK recorded 78.4%. But after that, in terms of what maybe 2005 or net profit margin, GSK is better than what AZ. So depending on which company you're analyzing, and please be careful when you are benchmarking your company, all right, against another company. The focus is on your company and not the other company. Because some people, when they are benchmarking their company with another company, then they will start discussing the other company. It's your own company. You are only comparing it with the other company. So your focus is on your company. Is that okay? Don't leave your company and now start discussing the benchmark. Is that all right? Okay? Now, if we go to return on equity, we said this one is simply profit after tax and minority interest and preference dividend. That's profits after tax, after minority interest, and after preference dividend, divided by the shareholders' fund. I said the shareholders' fund is the same as what? As the shareholders' equity. All right? So if you go back, let's look at profit after tax, minority interest, and preference dividend. So take note of the figures. All right? So if we go back to the income statement now, look at it. It says, this is profit after tax. Is that not? Then, it says after minority interest. So we deduct minority interest, which is this. Profit attributable to minority interest. So we deduct this. And preference dividend. But in this case, we have no preference shares. So no preference dividend. We are only interested in profit after tax and minority interest. So if you deduct this minority interest from profit after tax, what we are left with is what? Profit attributable to equity shareholders of the parents. Is that okay? So this is the profit attributable to the shareholders of the parents, and that is what we use. So you can see the figure 3088, 2741, and here 5389 and 4689. Is that all right? So for return on equity, you are looking at the profit attributable to the shareholders of the parent is the same as profit after tax and minority interest. Is that all right? So we say they are the same. Now, shareholders fund. Where is your shareholders fund? Your shareholders fund is here. But remember, this is the total shareholders fund. This is total equity. But this portion belongs to minority interest. It belongs to minority shareholders. So we need to deduct that. And therefore, we have what? The equity or the shareholders fund for the parent, for the shareholders of the parent company, which is this. This is what you want. 9386, 7311, and this one 7820 and 7920. So take note so that you know where to get your figures from. Is that okay? When you are doing your calculations, we start sending email. I can't find this. You know, the number of emails you receive during assessments, honestly, just little thing. That's why I'm emphasizing it now. So you can imagine if almost 300 of you are sending emails about where to find the shareholders fund. So you can see how long it will take before I get to your email. And some people, after waiting for a few hours, they send reminder. And once you send reminder, it will push your mail to the top of the pile. You know, once you send a new email, it will go to the top. So if I'm working down up, then maybe 2 weeks after the deadline, I will get to your email. So please, let's note now, if there's anything you are not sure of, just ask me now. So that we can minimize emails. So you can see your figures here now. When you choose your company, the same. Is that okay? And that's why I said, go now to 2020-2021 financial statement, which I saved there in the folder. I want you to look for those figures for me. All right? So you will need to do the same for your own chosen companies. All right? So you can see the figures here. Your profits attributable to the shareholders of the parent over the shareholders fund. Is that okay? Of the parent. So we have it for 2006, 2005 for AZ, and we have the same for GSK. When you do your calculation, we have 39.5, AZ 34.6. It increased from 34.6 to 39.5, but in the case of GSK, it decreased from 64.1 to what? To 57.4. Although when we compare the two companies, we can say GSK is still what? It's still performing better than AZ. Right? It's still better than AZ. And when it comes to return on capital employed, I said your PBIT, profit before interest and tax, if you have no other income, that's your earnings, that's your operating profit. Is that okay? So just go to your operating profit and pick your operating profit. So we have profit before interest and tax over capital employed. So the calculation of your capital employed is what? Shareholders fund plus preference share capital plus minority interest plus debt. And that is why we use profit before interest and tax, before any appropriation at all. All right, to any capital provider. And I said the easier option is just to take your total assets and deduct your current liabilities to calculate your capital employed. That is still fine. All right? Any question? And that is profitability. Yes. Shareholders fund.
I'm kind of look, I was following with that.
No, you are not following very well. So you need to follow very well. See the shareholders fund here. I said this is what you go for. This is your shareholders fund. It's equity. This is your total equity minus minority interest. You are now left with what? The equity belonging to the shareholders of the parent. And that is the shareholders fund of the parent. That is what you want. Is that okay? Any other question? Everybody's fine? Okay, I'm happy. You're all happy. So at least everybody's happy. So we can move on now. Efficiency ratios. Remember in the case of efficiency ratios, we said the purpose of this is to assess the extent to which assets and liabilities are well utilized and well managed. So most commonly used efficiency ratios include the stock turnover period. You are simply measuring how long it takes for the company to do what? To sell its inventories. Yes. For how long do they hold their stocks? How many days does it take them to sell their stocks, their inventories? Is that all right? That's what we are doing here. So for the inventory turnover efficiency, some will just calculate inventory turnover ratio, which is still okay. But this one, we are only looking at how many times we are able to do what? Turn over our stocks over a year, within a year. Whether 3 times, 4 times. But the stock over turnover period is a measure of the number of days it takes. While stock turnover is a simple measure of how many times. So just know the difference. Some people get it confused, and at the end of the day, they start interpreting the two as the same. No, they're not the same thing. So if you calculate any of them, your calculation is right, but you may not get the interpretation. Is that okay? So make sure you get the right interpretation. If you calculate turnover ratio, fine. You will not be penalized. If you go for a turnover period, is that okay? You will not be penalized. But you just need to provide the correct interpretation. All right? So the second one is debtors collection period, which is a measure of what? How long it takes the company to recover sales from customers. How long does it take them? How many days does it take for them to recover money from customers? That is credit sales to customers. We are looking at how long it takes them to collect their money from customers. Then the creditors payment period is simply looking at how long it takes for the company to pay suppliers for goods supplied to them, to pay their creditors. Is that okay? We are looking at the number of days it takes them to pay their creditors. And then we look at asset turnover ratio. Asset turnover is simply looking at how many times the company is able to use its asset to generate sales. So you want to look at how many times your sales cover your what? Your capital employed. All right? And again here, you can decide to go for total assets, you can decide to go for capital employed. You will not be penalized. So all you need to do is to make very clear your formula. Okay? So now, efficiency ratios. Inventory stock turnover period. We said measures the average period for which stocks are being held. All right? It simply tells you how long does it take for you to sell your stocks. How long do you keep your stock in the warehouse? How many days? All right? And this is simply what? Again here, your average stock, or just use your closing stock. It's still the same application here. If you are using average, make sure you use average all through. If you are using closing, use closing all through. So it says average stock over cost of sales multiplied by 365 days. All right? Multiply by 365 days. And that will give you the number of days. You see, you may use closing stock figure if opening stock figure is unavailable, but you just need to be consistent. In the case of receivables or debtors collection period, we said this is a measure of how long it takes for the company, how many days does it take before they recover credit sales from customers, before they get paid. Remember, this will have an impact on the liquidity of the company. Is that okay? We said in finance, cash is what? King. It's cash we're after and not really profitability. It's possible for a company to be making profit and still go bankrupt. But when the company is generating cash, they're able to collect what? Their cash from the customers. They will have enough money to meet their day-to-day financial obligations. Is that okay? So this has an impact, and that is why we will talk more about this when we get to working capital management. We'll still get to working capital management later, and we'll talk more about this area, these ratios. All right? Then, this is average receivables. Remember, your debtors, your receivables, they are the same thing. Remember, your stock is also the same as your inventories. Is that okay? Stocks is the same as inventories. Your receivables is as the same as what? As your debtors. So, whether your company, they call their own debtors, we are talking of the same thing. All right? Whether they call it debtors or they call it receivables, we are referring to the same thing. So, here, your average closing receivables over credit sales. But because it's difficult to do what? To get the credit sales, we just go for what? Your sales. Just take sales. Take your turnover. turnover, revenue, sales. Is that okay? Don't bother about the credit sales. Is that okay? So, yeah, question?
Sir, I think I understand the question you asked now about service companies and product companies.
Yes.
The service company will have average aging for their sales. That means how long does it take you to convert an opportunity to a sale? And it's different when it's stock. So how do I calculate the efficiency of a service company that does not have stock?
Does not have stock. All right. And if we are looking at efficiency, and that's why we have so many efficiency ratios. Is that okay? It's not limited to these four. So if you are looking at a service company, definitely, if you are not looking at receivables, you are looking at what? Whether payables, they may have creditors, they may have debtors, they will have assets. Is that okay? They have revenue, total revenue or total income, and they have assets and so on. So you have so many ratios, you have so many ways. And that's why I said you are not restricted in terms of the calculation. You have different ratios for calculating efficiency. These are just examples. And we say these are the commonly used ones. So depending on the type of information you have. All right? So if we decide to start looking at financial services, not many people will write on financial services. Maybe at the end of the day, you have just 3, 4, or even out of the almost 300, maybe less than 10 people I can say will write on financial services at the end of the day. Most people are going to write on manufacturing and other services companies. Is that okay? So, and that is why you have different terminologies, you have different items, but you will only be required to calculate 2 from each category. So you will always find 2 to calculate. Is that okay? All right. So now, we have the receivables, and then we move on to our payables turnover period. That is, how long does it take to pay our creditors? All right? To pay our suppliers. That will be average payables, or your closing payables, over cost of sales multiplied by 365 days. And that will give you the number of days. And finally, we go down to asset turnover ratio, which measures how effectively the capital employed by the business are being used to generate sales revenue. How well are they using their capital to generate what? Sales revenue. And that is what? Your asset turnover ratio. So if we go back to the 2 companies now, in terms of efficiency ratio, let's look at AZ. AstraZeneca, for 2006, closing stock over cost of sales multiplied by 365 days. So for your closing inventories, we have 1150, 1285, 2437, and 5010. Where on the financial statement do you get your inventory figures? Balance sheet. So under which part? Current assets. Correct. Is that okay? Everybody's clear with that? So if you go back to your income statement now, to your balance sheet, sorry, all right, and you look at the current assets, look at your current assets here, you will see your inventories. We said it's the same thing as stocks. Is that okay? So you have your inventories here. And remember, your cost of sales is coming from here. You have your turnover here, you have your cost of sales. You are getting your turnover figures from your income statement and your cost of sales. Then your inventories coming from your balance sheet. All right? Which is under current assets. Even your receivables, you can see your receivables here. If you go to current liabilities, you will find your payables here. Okay? So you have your payables. So for our calculations now, if we go back, you will find your stock turnover period, that is your closing inventories over cost of sales, multiplied by 365 days. And that will give us 147.8 days. 147 days for AZ. So for GSK, 2437. Check the financial statement you have with you. That's why I said you should open the financial statement so that you can see where the figures are coming from. Can you confirm the figure? Can you all see the figures? Can you all see the figures? Is everybody comfortable with the figures? You know where they are coming from? Let us know now so that we can help you. Before you are alone at home. When you are alone at home, we will not be there with you. If you can't see it now, just tell us. Let's see how we can assist. We can help you to see it quickly. Okay. So, if we look at the stock turnover period, we have 147.8, 150. For debtors turnover period, 59.1. And creditors turnover period, we have 228.6. And for what? 2005, we have 215.4. If you now compare that with GSK, it takes GSK 177.5 days, 177 and a half days for them to do what? To sell their stocks. So which means their stocks are held in stock or in the warehouse for 177 and a half days before selling them off. Whereas it took AZ 147, okay, 0.8 days. Let's see, 148 days. So if we look at all this calculation, which company is performing better? AstraZeneca, as you can see. And in terms of debtors now, it takes 59 days to recover their debt from customers, while it takes 68 days. GSK takes 68 days for them to recover their debt from customers. So again, which company is performing better? AZ. When it comes to creditors, creditors turnover period. For AZ, it takes 228 days. And for GSK, it takes 63 days only for them to pay their creditors. And in 2005, it was 215. For GSK, it was 62.7. So which company is performing better? GSK. All right. But in the case of creditors, it's the other way around. The longer, the better. So, the longer it takes, the better. It's a sign of credibility. Trust by a supplier, your credit worthiness. Your suppliers have confidence in you. Your creditors trust you that one day you will pay. Is it not? They believe no matter how long it takes, you will pay. So they have confidence in your ability to pay your debt. And also, it's a sign of liquidity, which means you are able to use your supplier's money for your day-to-day operation. You have enough time to use their money. Is that okay for your own operations? You are not under pressure to pay off your debt. So you can use the money at least for some time before you pay it off. So that's a sign of what? Liquidity. But at the same time, we need to be careful, because the market may misinterpret it as what? A liquidity problem. That the company is struggling to pay their creditors. Is that okay? So the market may begin to think, this company, they are having what? Liquidity problem. They have a cash problem. And for you as a supplier, if you see such a company that is taking 228 days to pay, do you want to supply them? So these are the dangers. So for existing suppliers, they may be comfortable. Yes, at least they are able to sell their products somewhere. Yes, at least you know someone is owing you. Is it not? At least somebody is owing you. And you know one day the person will pay. But if you're a new supplier, you too, you want to collect your money. You can see they are aggressive. That's aggressive working capital management. So when we get to working capital, we'll talk about it. They are chasing their customers to collect their money, but they are not paying their suppliers on time. They are not paying their creditors on time, but they are chasing their suppliers, their customers to pay. That's aggressive working capital management. You want to squeeze your customers to pay, but you take time in paying your creditors. Is that okay? Because you want to use their money for some time. All right? So now we say, therefore, AZ is better. It means creditors have confidence in AZ more than GSK. And in terms of asset turnover, we have what? Your sales divided by your capital employed. And we'll say we are looking at the company's ability. We are measuring the company's ability to use its capital to generate what? Revenue, to generate sales. And in this case, as we can see, for AZ it's 1.59 times, for 2006, and for 2005, 1.61. For GSK, it was 1.54 in 2005, and that decreased to 1.53. They are relatively stable. Is that not? So, again, we said AZ is performing better. So, when you look at it, in terms of efficiency, AZ is what? It's more efficient than GSK. But in terms of profitability, GSK is more profitable. Ordinarily, we now say, all right, efficiency should translate to what? Profitability. Is that not? But some things, a lot of things goes into the calculation of profitability. All right? We'll talk about that later. Profitability, you need to factor in some things. For example, your level of gearing, which will affect the amount of interest paid, and even when we look at gross profits. In case of gross profit, you will see that AZ was better. So, and this is where we can really measure the impact of efficiency, and also on the operating expenses, down to operating profits. But net profits, no. Okay, so any question now? I think at this point, you want to stretch your legs, right? And take fresh air. Okay, so let's take fresh air and come back by when? 5 past or 10 past? Okay, let's say 10 past. Okay, so stretch your legs and come back by 10 past, and then we move on. Let's resume and then look at liquidity. Let's look at liquidity ratio. Remember, we said in case of liquidity, we are simply measuring the ability of a company to meet, the lecture is on, please. We are simply measuring the ability of a company to meet its short-term financial obligations. And here, all right, we are simply looking at how comfortable the company is in meeting its short-term liabilities from its short-term asset, that is from its current asset. And we have also in these categories 2 main ratios. We have the current ratios and we have the quick ratios. Is that okay? The current ratio and the quick ratio, which is also known as what? As asset test. All right? It's an asset test. You want to see how quickly the company will be able to raise cash to meet its short-term liabilities or its current liabilities. So for the current ratio, it's simply looking at the ability of the company to meet its short-term liabilities from what? Its current assets, its liquid assets. And it's calculated as current assets over current liabilities. Okay? So it's simply current assets over current liabilities. And here we say a current ratio of greater than 2 is considered healthy, but this depends on the sector. So your current ratio varies from sector to sector. All right? When we are evaluating the performance of a company, we need to put the sector in perspective. Is that okay? Then, the quick ratio, on the other hand, which is our asset test, we are simply looking at the ability of the company to do or to generate cash, to convert its asset to cash. So we are looking at the liquid asset. And when you look at the current asset, we can say inventory is the most illiquid. All right? It's not very liquid, it's illiquid. Because for you to convert inventory, your stock to cash, you still need to look for buyers. Is that not? You will look for people to buy those goods before you now start thinking of how to make them pay. So you will sell, you will look for buyer to sell, who will buy from you, and then you start thinking of how to recover your money from them. So it's not as liquid as maybe account receivables, for example. Account receivables, you've sold the goods. If you quickly want to collect the money from the customers, all you can do is maybe offer them cash discounts. Is that okay? You can say, if you pay within the next 7 days, I'll give you 5% discount. If a company is owing you 100 million and you offer them 5% discount, that's 5 million. If they have the cash, definitely, if they have the money, they will pay. Because that's 5 million profit. That's 5 million additional profit. So if they have that money, they will pay. Therefore, you can quickly convert that to cash. But in the case of inventories, no, it will take some time. You need to look for buyers first. And that is why when calculating the quick ratio, we deduct inventories. Is that okay? We are looking at those ones we can quickly convert to cash without a significant loss in value. Is that okay? So that is current assets minus inventory over current liabilities. And we say for this one, anything greater than 1 is considered healthy. But again, we need to consider the industry. So we said the industry is also very important here. So if we now look at the two companies again, looking at their current assets, go back into the balance sheet. So you have it there. I just want to show you one of them. We say it is current assets over current liabilities. The current assets for GSK, 10.992, 13.177. For AZ, we have 8.653 against 8.021. And we say current assets over current liabilities. We have our current liabilities here, so we have 7265 against 9511 and 4827 against 3984 for 2006 and 2005 respectively. Okay, so now if you now the current assets over current liabilities, and if you go back to your current asset, you will find inventories. Remember we said we need to deduct inventories for quick ratio. So just to look at the two figures before we now go down to the calculations. Okay, so our current asset equals 8653 over 4820, and that will give us 1.72, and for GSK 1.51. For 2005 it was 2 for AZ and 1.39 for GSK. Okay, so and looking at this, we'll say what? AZ performs better than GSK. Okay, so now quick ratio, your current asset minus stocks, that's inventories, which will now be 8653 minus 1150 over 4827, and that will give us 1.55 for 2006, 1.69 for 2005 for AZ, and for GSK 1.18 and 1.16. So we can see that for both ratios, what? AZ performs better than GSK. All right? So then remember, for your assessment, the calculated ratios, you need to interpret them. You need to tell us what they mean. Don't just describe them. Is that okay? Simply this one, for example, your current ratio, remember we said, simply measure the company's ability to meet its short-term financial obligation from its current asset. So here, we can say that the current asset of the company is 1.75 times its current liabilities, which shows that the company has enough current assets to meet its current liabilities. Is that okay? So please, remember, you need to interpret the calculated ratio. Don't just define the ratio and leave it there. When you calculate your ratio, you also need to interpret and tell us what it means. Okay? So for this one, that is just simply the meaning. So we have the GSK and AZ. I would say AZ performed better than GSK. So now, the solvency. Remember we said solvency is simply a measure of the company's ability to meet its long-term financial obligation. And here we have what? Two common ratios. We have the gearing ratio and we have the interest cover. The gearing ratio is simply a measure of the financial risk of a company. Remember, we said when you borrow money, okay, when a company borrows, whether the company makes profit or not, the company must pay interest on that loan and repay principal at maturity. So debt holders are not concerned with whether the company makes profit or not. They have to fulfill their contractual obligations by simply paying interest and repaying principal at maturity. If they fail to service their debt, then the debt holders can force the company to liquidation. Is that okay? They can force the company to liquidation. Therefore, the higher the level of debt, the closer the company is to bankruptcy. Because the more difficult it becomes for the company to service the debt. So, the only thing we need to note is that we don't just look at the level of debt. We look at the capacity of the company to service that debt. If they are generating enough revenue, enough profit to pay the interest, then that is still fine. It will be in the interest of the shareholders. Because anything remaining after paying interest belongs to the shareholders. Is that all right? And we also derive tax benefit from the use of debt because the interest on loan is tax deductible. When you calculate your profit before interest and tax, then you deduct interest on loan. That will reduce your taxable profit and reduce your tax liability. It will reduce the amount of tax you pay eventually. And at the end of the day, increase the return on shareholders' fund. Because whatever is now left belongs to the shareholders. Is that okay? So, we'll say this one is very important because it's a measure of the financial risk of the company. The higher the level of debt, the riskier the company becomes. Okay? So here now, we said the most commonly used ratios are what? Gearing ratio and interest cover ratio. Also here, we have debt to equity ratio. And the common mistake students make is what? Calculating debt to equity ratio as gearing ratio. They are not the same thing, and they begin to interpret them as the same. They are not the same thing. Gearing ratio is simply a measure of the percentage of the company's capital that is what? That is debt. It's looking at debt capital as a percentage of the total capital of the company. While debt to equity ratio is a measure of the amount of debt per unit of equity. For every pound of equity, how much is the company owing? That is what debt to equity ratio is what? It's measuring. It's simply measuring debt per pound of equity. So they are both measuring the solvency of the company, the ability of the company to do what? To meet its long-term obligations, but they are not the same. So don't interpret them as the same thing. If you calculate either of them, you may get the marks for calculating it, but the explanation, if you explain debt to equity ratio as gearing ratio, then your interpretation will be wrong. All right? So take note of that. So when we look at gearing, I said, it's simply looking at your debt as a percentage of your total equity, or your total capital. So therefore, it is debt over debt plus equity. Remember, your capital is what? It's made up of equity and debt. So when we are saying debt here, we are looking at interest-bearing debt. All right? We are looking at interest-bearing debt. Because we have other debts that are not what? Interest-bearing. But we are only concerned with the interest-bearing debt. So our gearing ratio is debt over debt plus equity. And when we talk of interest-bearing debt now, we are talking of loan notes or loan stocks. We are talking of bonds, debentures, term loans, that's borrowing, finance lease obligations, and redeemable preference shares. Remember we said preference share is a hybrid instrument. It has both elements of equity and debt. If it is redeemable, then it becomes debt. If it is irredeemable, then it is equity. Is that okay? So we have redeemable preference shares and irredeemable preference shares. Redeemable preference shares simply means at some point in future, the company will need to pay back. They will redeem the preference shares. They will pay back the preference shares holder. Is that okay? But in the case of irredeemable, they will never pay back. All you can do as a preference shareholder, if you want to liquidate your position, is to sell. Is that okay? To other investors, others who are interested in buying the share capital of the preference shares of the company. So, all right, we said it's a measure of the financial risk of the company. High level of debt is not a bad thing if the company has the capacity to service. So it's the capacity to service that is important, not necessarily the level of debt. Is that okay? So if you look at maybe an example here, this is just an additional note to demonstrate the importance of gearing ratio. You can have a look. We have two companies. One, if you look at the capital for these two companies, for company A, it has ordinary share capital of 100 million. Company B has 200 million. A has what? Loan capital of 200, while B has loan capital of 100. They both have total capital of 300 million. Is that okay? But if you are looking at the gearing ratio, A has a gearing ratio of 200 over 300. That's 67%. B has gearing ratio of 100 over 300. That's 33%. Now, if we are looking at, let's say they have the same amount of profit before interest and tax. For A, we said it's 10% loan. A will pay interest of 20%. B will pay interest of 10%. Sorry, A, 10% of 200 million, that will be 20 million. B, 10% of 100 million, that is 10 million. And that will give us what? After That's profit before tax of 30 million and 40 million. When you calculate the tax liability at 30%, A will pay tax of 9,000, B will pay tax of 12,000 because they have less debt liability. And at the end of the day, we have what? Profit after tax of 21 and 28. The only thing is, if you now want to look at return on equity, you will discover that A, we have higher return on equity because it will be 21 divided by what? 100. Why this one will be 28 over 200. So return to equity holders will be higher for A because the bulk of their capital is what? Is debt and not equity. All right? That will be debt and not equity. And if we have an increase in profit before interest and tax, you discover that the profit of A will grow faster than the profit of B. And I see the percentage increase here. The percentage increase in after-tax profit will be higher for A than B because of what? The tax benefits. All right? So, when you get home, go through the additional note. This is just to give you additional explanation. But when we now come to what? Our AZ and GSK. Now, the gearing ratio for AZ, debt over equity plus debt. So here we are using interest-bearing debt. And that is why we may have short-term and long-term. Okay? So for GSK, the gearing ratio is 36.3% for 2006 and 46.1% for 2005. But for AZ, 8.1, 7.3. Remember we said the higher the gearing ratio, the higher the financial risk of the company. Which means what? AZ is performing better. All right? AZ is not as risky as GSK. And interest cover, you can see how many times. This is just a measure of how many times the what? The profit covers the interest obligation. So here we take profit before interest and tax. So we use our operating profits now. Okay? Remember we said this can also be calculated in two ways. So you just take your operating profit and then divide it by what? The interest expense. And that will give you the number of times. So here we can take our operating profit plus interest income divided by interest expense. And that will give us 108.9 times. This 118.9 times. For GSK, we have 15.9 times and 23.3 times. Well, both of them are healthy. Is that okay? This simply means the operating profits is what? 15 times the interest obligation. So the company is comfortable. Is that all right? GSK is comfortable. And AZ, because of their low gearing, because they have low debt, we have low interest payment, and therefore the interest cover ratio is very high. You can see 118 times. So which means to them, they are not at risk at all. They are not at risk of meeting their long-term financial obligations. Is that okay? So AZ is performing better than GSK. Any question? It's like you are getting dazed now. Everybody's quiet. The thing is beginning to sink in, right? It's sinking in. So let's look at the last one, investment ratios. Okay, let's look at the investment ratios. We said this to help investors assess the return on their investment. Why do we calculate investment ratios? To help investors assess the return on their investment. And therefore, the most commonly used investment ratios includes what? Earnings per share, price earning ratio, PE ratio, dividend cover ratio, and dividend yield ratio. In the case of earnings per share on its own will not tell you much. It's just a simple measure of what? The company's earnings per ordinary share. What does it tell you? Not much. Is that okay? On its own, it won't tell you much until you combine it with something else. Whether PE ratio, payout ratio, and so on. Okay? So, your EPS is simply profit attributable to ordinary shareholders divided by the number of ordinary shares in issue. For the investment ratio, we calculate this for public companies because we calculate this from published financial statements. So it's mainly calculated for companies that are listed on an exchange. Is that okay? We calculate investment ratio for listed companies. And here you have the earnings per share. Most of them will calculate the earnings per share for you. Because except you are given the average number of shares, you may find it difficult to calculate the earnings accurately. But if you have the average number of shares, then you are fine. Just take the total earnings for the year and divide it by the average number of shares. That is the net profit or profit after tax for the year. Is that okay? Divide by the average number of outstanding shares. And that will give you your EPS. But in the case of price earning ratio, it's a simple measure of the confidence of the market in the ability of the company to generate long-term profit. That is the future profitability of the company. Because this is simply looking at how many times the share price of a company covers the what? The earnings. It's simply measuring how many years it will take before the earnings of the company will be equal to the price. Is that okay? Earnings per share will be equal to the share price. That is how long it will take, the number of years it will take for you to recover the price you pay for the shares of the company from the earnings. So, if you have a PE ratios of 20, for example, that is simply saying it will take 20 years, all right, for you to recover the price you pay from the company's earnings. Is that okay? So it's a measure of the confidence. And we say dividend cover ratio. This one is a simple measure of the ability of the business to pay dividend out of its current profit. You are looking at how many times, all right, the company's profit covers the dividend. So we are looking at their ability to simply pay dividend out of their current profits. And that is calculated as profit attributable to ordinary shareholders over dividend paid. All right? And finally, dividend yield. Dividend yield is simply a measure of the return on investment, your percentage return. Let's say you paid £10 for the shares of Cadbury and you receive dividend of £1. What's your percentage return? 1 over 10 multiplied by 100, that's 10%. So which means you've only received 10% return on your investment, and that is your dividend yield. Okay? This is straightforward. All right. So now, investment ratios calculation for AZ and GSK. To calculate this, we have additional information, the share price. Okay, we have the share price. Here we are taking the share price on earnings announcement date. That is the day they announce their results. Is that okay? What's the price? What's the closing price on that day? So we pick the closing price, and this is the price. Then the weighted average number of shares in issue. Remember I said, is the weighted average number of shares. If you don't have the weighted average number of shares, you may not be able to calculate the earnings per share. Is that okay? Because if a company decides to issue shares during the year, in maybe June, end of June, which means they are only using that capital for what? 6 months. That's July to December. So if you are calculating the outstanding number of shares, you will only recognize half. That is from the date they issue that share. And that's why the calculation of the weighted average number of shares is a bit complicated. All right? And we are not going into that. So if you are given by your company, then take it and calculate the EPS. If you are not given, just take the EPS calculated. Is that okay? And try and stay away from just ordinary EPS. It won't tell you much. So it's either you calculate the PE ratio, or you calculate dividend cover or dividend yield. Is that okay? Don't calculate EPS on its own. So for GSK now and AZ, we have the earnings per share, which is 1.97, 1695, and 0.955, 0.8. I think this one, AZ, is better and not GSK. So if you look at PE ratio, GSK is 14.9 against 17.6 in 2005, while AZ 14.7 against 15.6. So here, PE ratio, GSK is what? Is better. GSK is performing better. So that what this one is simply telling you, that's what the higher the PE ratio, the more the confidence the market has in the company. That's a measure of the confidence of the market. So the higher the PE ratio, the better for the company. Is that okay? That shows that the market really believes in the long-term future of the company. Is that okay? So make sure you interpret your ratios. Don't just describe, as I said. You have your interpretation here. Look at it, do your interpretation. And you have your dividend cover ratio, all right? Profits attributable to equity shareholders over dividend. And we are saying this is 2.73 against 2.81. And for GSK, 2 against 1.88. So here, you can see that word. The profits for over the dividend 2.73 times, which means the company is comfortably paying dividend out of current profits. Is that okay? Because their profit is almost 3 times the dividend paid. So they won't have any problem paying that dividend. They made enough profit, so they can pay it out of their current profits. Is that okay? That's the interpretation. You need to interpret your calculated ratios. And finally, dividend yield. This is simply a measure of percentage return on investment by the shareholders. By calculating the what? The dividend as a percentage of the price paid by the investor. And in this case, for GSK, we have 3.4, 3.3% in the prior year, and for AZ, we have 2.5 and 2.3 in the prior year. Which simply means what? GSK performed better, yielded higher return than AZ in those 2 periods. All right? Any question? You are still digesting it. You are still digesting. Yeah, don't worry. When you get home, make sure you take cold shower. Take a cold bath and sleep. And then, so it's not cold yet. So the weather is still hot now. So you can still take cold bath. Yes. What's the question? As I said, any company of your choice. Yes. The only thing is, remember, if you decide to write on your company, the company you work for, then you will need to complete the ethic form. Is that okay? So remember, if you are writing on your company, all right, the company where you work, you need to complete ethics form. Is that okay? So that's the only caveat. You can write on any other company. No, any other company listed on an exchange, you don't need the ethics form because the information regarding that company are what? Publicly available. So you are not likely to violate any ethical practice. So, yes, another one. Okay, so complete your question now.
So some companies below some of their components of their financial statements, like some companies over the years they don't be declaring dividends and other things. Some don't have their minority interest when it comes to their preferences and other things. Some companies they don't have all these things on their financial statements. So in case you want to use them in your assignment, how do you handle those ones?
Yes, how you can handle those ones is to make sure you check the financial statement before you start and you have all the information you need.
We are not allowed to choose any company.
You can choose any company as long as they have the information you need. If you decide to choose that company and you don't do the relevant calculation, that is your own headache and not mine. Is that okay? So it is up to you to make sure you have all the information you need before you start. Is that okay? So you can choose the company, just make sure they have the information you need. If not, you're on your own. So now, please, the lecture is still on, we have not finished. So cautions and limitations. Remember, we said the quality of the financial statement has a direct impact on the quality of your ratios. If the financial statement is manipulated by management, then what do you think will happen? Because you have some companies, is that okay? They will just tell you, okay, this is how much tax you want to pay. So you work from there now to derive the profits. Instead of calculating profit from, calculating tax from your profit, you calculate profit from the tax based on what your client wants to pay. Is that okay? And then at the end of the day, so you just declare your profit. So it depends on the accuracy of the financial statement. And also remember that these financial statements are prepared using historical cost convention. So the amount on the financial statement are simply the amount you paid when you bought this asset and may not necessarily represent the true market value of the company. Is that okay? So, and that is why we need to adjust them for fair value during acquisition and so on. That's why when we were talking about acquisition, I said we need to take so many things into consideration. Is that okay? Because we may need to adjust them for fair value. All right? So we said inflation affects the value of some of the items and therefore it will not present the true value of the company. And also financial ratios are myopic in nature. All right? They only look at what? The short term. They look at the financial aspect. I think, okay, you are talking about some of the benefits enjoyed by one company against the other. Yes, ratio is only looking at what? The financial aspect. They are not considering all those qualitative factors. Is that okay? They are not looking at other factors which may affect the financial performance of a company. All right? So, we've talked about the financial statement. We simply present a snapshot of the position of the company as at a particular point in time. But remember, we said that position can change at any time. All right? That may not necessarily be a good prediction of the future because the financial position can change at any point. So any ratio based on the financial statement is only temporary because when there is a change, then the ratio should change. Is that okay? And also, when looking at the basis for comparison, we need to consider what? The differences in generally acceptable accounting practices. That is, if you are making comparison across borders. So we need to take this into consideration. And also, ratio will only give you an indication that something is going wrong and not necessarily the cause. Is that all right? So it is now your responsibility to investigate the cause. All right? So please, in summary, financial statement analysis is a useful technique to help users understand and interpret financial statements. It allows users to evaluate the financial performance of a business over time and in relation to other businesses. Ratio analysis helps users evaluate the financial strengths and weaknesses of a business in 5 major categories: profitability, liquidity, solvency, efficiency, and investment returns over time and across companies. Financial analysis is not an exact science. It also requires what? Your own judgment. Is that okay? So it requires your judgment. Any question? Any question? No question. You just want to go home. So what question now? Yeah, I can see I'm happy because everybody's happy. Everything is clear. So when you get home, just take your time. Yeah.